Well, hey everybody, greetings from Nashville, Music City. Glad you could join us today. Today's webinar is the 9 hidden costs of self-funding your case expenses, and we'll get started right away. So a brief introduction. This is me. I'm Mike Swanson. I'm the CEO of Advocate Capital, also the president, 1/3 of the credit committee, and one of 2 owners of the business. I'm also the author of a book called How David Beats Goliath. It's the only published finance training book for plaintiff lawyers, and you can get that on iTunes, Amazon.com, etc. And if you're attending this webinar and you'd like a copy, just message me afterwards. I'd be happy to send you an autographed copy of the book. So those are my bases for knowing how to talk about case expenses. I want to be sure to let you know that I do have a dog in the hunt. The AdvoTrack Case Expense Funding Service, which is what Advocate Capital does to help plaintiff lawyers, is an alternative to self-funding case expenses, but we're not going to do a sales pitch for Advocate today. We're going to talk about our topic, which is the 9 hidden costs. As I mentioned, if you'd like a copy of my book, message me. I'd be happy to send it to you. I also want to do a disclaimer, which is that I am not a lawyer, I am not a CPA. So if you're considering actions to take or not take based upon today's webinar, be sure to check with your accounting and legal professionals first. All right, great. Well, today I'm going to ask you or challenge you to think a little differently about an asset that your law firm owns. If you're a plaintiff lawyer, partner in a plaintiff law firm, you may not have thought about your case expense asset the way I'll encourage you to think of that today. And we're going to talk about the hidden costs. So the hidden costs are something that are there, they're real, but you don't always see them, so you might not give them full consideration. But before we talk about that, we're going to take a poll, the first of a few polls. We'd like today to be interactive for you. So the first poll we're going to take is going to be asking you, where should case expenses appear on the financial statements for a contingent fee law firm? Should they appear on the income statement, on the balance sheet, all of the above, or none of the above? And I'll give you a few moments to go ahead and vote. Click on the one that you think is the right answer. Is it the income statement, the balance sheet, all of the above, none of the above? By the way, your answers are anonymous. I can't see them, so pick one. Do your best. If you don't know, just take a guess. By the way, while you're voting for this, I should let you know that our building manager told us about 45 minutes ago that the fire department is here and they're going to test the alarms today. So I want to apologize in advance if you hear a fire alarm going off. I won't leave the building because we're not really in danger, but we'll muddle through with the webinar nonetheless. Okay, we see some votes coming in now. Where should case expenses appear? Income statement, balance sheet, all of the above, none of the above, and we'll give you a chance to just another couple seconds to vote here. Okay, we're going to close that out, and you did pretty well. 2/3 of you got the right answer, and the right answer is that your case expenses should appear on the balance sheet. That's my opinion. I'm not a CPA, but I think it's pretty clear because the IRS says in their private letter ruling 8246013 that case expenses should not be deducted from current year income, right, like any other expense you'd have. Rather, they are technically, or in effect, a loan that the law firm has made to their clients. And because those case expenses come back to the law firm so consistently on such a high rate, probably 95% of the time, the IRS ruled and gave guidance that they should be treated as an asset. So you should always see assets on the balance sheet, right? On a balance sheet, you see assets and liabilities and equity. On the income statement, you see income and expenses and profit at the end. So there's no place really on an income statement for case expenses because they're an asset. All right, let's continue. Let's think about the money that you have tied up in case expenses. Where did that money come from, right? Well, you probably know it came from legal fees. Let's look at an example and kind of back into how much you have to take in as a law firm in total settlements or verdicts to come up with after-tax cash of $500,000 to have in your case expenses. So how much do you think that is? How much do you think your law firm needs to bring in gross fee revenues, or rather in the settlements, to end up with $500,000 after taxes? Jot that number down. We're not going to do a poll, but let's walk through an example to do an approximation on that. So first of all, to come up with after tax of $500,000, you would have paid taxes. If you're in the 35% tax rate, you would have paid $269,000 and change in taxes. What that means is you made a pre-tax profit of $769,000, you paid the $269,000, you have $500,000 afterwards. Well, at every law firm there's overhead. We know from studying our database of plaintiff law firms around the country, the average overhead rate is about 55%. So you would have also paid about $940,000 in overhead. That means you started with gross legal fees of $1.7 million before you paid your overhead and your taxes. If the client portion on your fee agreements are 2/3, that means the clients would have had $3.4 million, and backing all the way out to the verdict or settlement number, you would have to bring in a little over $5 million if you're a typical law firm to net out after-tax cash of $500,000. So whether you have $100,000, $500,000, $1 million tied up in your cases, you can kind of use that 10-to-1 rule, right? So whatever you have, if you have $100,000 in case expenses, it probably took about $1 million of verdicts and settlements to net that amount out. You might not even do that much in 1 year, so it could be the complete revenue for a couple years at the law firm. All right, let's take another poll, and this poll is going to be on market value, because we're going to talk about the market value of assets, including your case expense. So what is the market value of an asset? It should be on your screen now. Is it the amount recently paid for the asset, the amount a willing buyer would pay, the value as determined by a licensed appraiser, or what a seller would be willing to sell it for? So guess what you think is the proper answer for that. I'll give you a moment to vote. Okay, see the votes coming in. Okay, the voting's almost done. We'll close it out in a second. Take a shot at what you think the value is, the market value of an item is. Okay. Give me another 5 seconds. Go ahead and guess one. They're anonymous. I can't tell who's who. So, okay. Well, that was interesting because we're going to close the poll out. It was split in roughly in thirds, where some of you thought the amount is what was recently paid for it, or when an appraiser would put a value on it, but the actual answer is the second one, which is the amount a willing buyer would pay a willing seller. So we're going to think about market value a little bit now in terms of your case expense asset. What's the market value of that? And we're going to look at 9 factors that really reduce the value as a hidden cost in your case expenses. The first is a reduction of liquidity. So what is liquidity? Liquidity is how fast an asset can be converted into cash. So cash is the ultimate test in liquidity. A house is not as liquid as cash. Your case expenses are very illiquid. How fast could you convert your case expenses into cash? I guess if you took no new cases in, you wound your practice down, you might get all that case expense money back out in 2 years, something like that. So it takes a long time to convert that to cash. So it's much less worth, much less than $500,000. I can explain that by an example. Would you rather have $500,000 of cash or a house worth $500,000? You'd rather have the cash because you can quickly do something else with that. If it was a house, you'd have to sell it, get the funds, have a closing, and convert it into cash. So you'd be much more likely to want to take the cash, right? And part of that is because of the liquidity. Okay, next is a lack of utility. Your case expense dollars tied up in your law firm can't be used for anything, right? And so that's another factor that has undermined the value of that asset even further. An example would be if you had 2 houses and each house was worth $500,000. House A you could use for anything you want. You could live in it, you could rent it, do whatever you want with it. House B, you could own it, but you couldn't use it. You weren't allowed to live in it. Which house would you want? I mean, obviously, you'd want house A because you can do something with it. Well, the same principle applies to your case expense dollars. Would you rather have $500,000 in cash or $500,000 you can't do anything with? Your case expense dollars there. So it's a lack of utility in the asset further undermines that. All right, number 3 is a lack of potential income. So your dollars are tied up, they can't generate any income for you, right? And in fact, it's guaranteed 0 potential income for your case expenses. Well, if you had your $500,000 in your hand and you could use that for something, you could convert it into an asset that could generate some income. So going back, you could buy a house and rent it and generate some income from that. You could do other things with it as well to generate income, but you're guaranteed 0 potential income from your case expenses. That was number 3. Number 4 is a lack of potential appreciation. So let's think about the types of assets that we want to own as business people, right? We want to own assets that are in 3 categories. Assets that are useful, assets that can produce income, and assets that can appreciate in value over time. And if the asset can do all 3 of those things, even the better. So your case expense As we've said, it's not useful, it's tied up indefinitely, it can't produce income, and it has a 0% chance of appreciation. So if I was a stockbroker and I said, I want you to buy this stock, it's $100 a share, but it's guaranteed never to increase in value, would that be a good investment? Of course not. But that's exactly what you've done by tying up your cash instead of investing in something that could appreciate over time. All right, next is increased risk. And this one's interesting to me because we talk to some lawyers and they think it's risky to finance your case expenses because they're debt averse and debt equals risk. Well, it's actually not that way if you think about it, because self-funding is not the safest way to go. Self-funding is actually risky because you're taking or allowing your cash to remain in the business and remain at risk, out of your control, where employees can embezzle it or it can get gobbled up through the operation of the firm. So it's much better to have your cash outside the law firm in a bank account. If you're not going to invest it, at least get it outside the law firm and out of harm's way. In an illustration of how risk impacts value, mortgages can be an asset that can be owned. So you can invest in mortgage-backed securities. People buy and sell mortgages. It's a loan someone owes on a house, and that's an asset. You can own that. So if I were to give you two choices here, mortgage A has a face value of $500,000. The borrower has a 730 credit score and put 20% down. You could have that mortgage, or you could have mortgage B, which has a 630 credit score and a 5% down payment. Well, there's obviously higher risk with mortgage B, and even though they're both for $500,000 in nominal value, the market value of mortgage B is going to be lower than mortgage A. So the higher risk lowers, again, the overall value of your asset that you've left in your business. So increased risk is something that most people don't think about very much. The best place for your cash, in my opinion, if you want ultimate safety, is in your personal bank account insured by the FDIC, not in your case expenses. Number 6 is taking a subordinate position. If you're not familiar with UCC law and this kind of thing, you might not be familiar with that term subordinate position. But so if you make a loan, you might require security interest. An example would be a UCC-1 filing on accounts receivable of a law firm. Well, if another lender comes in and wants to make a loan to the same law firm and they file another UCC, that second lender is subordinate to the first lender, right? So if in a liquidation, the first lender would get paid first. If there's anything left, the subordinate lender gets paid. So on a balance sheet, like we just took a look at, let's go back. At the balance sheet, you'll see near the bottom there are liabilities and an equity. Well, think about where your case expenses would end up in a liquidation. There are a lot of people who would be ahead of you. It's going to perform like equity, right? So you've taken a subordinate position, and there's that fire alarm. Hopefully it's not too loud. I'm going to keep going. There are a lot of people ahead of you in line. If we all know in this business that bad things happen to good people. If you get disabled or injured, something like that, and the law firm has a bump in the road for a while, what's going to happen to your case expense dollars? There are a lot of people ahead of you to get paid, right? Your lenders, your employees, taxes, operations, rent. If you have case expenses coming back out of your cases, they're going to get gobbled up, and you're only going to get something if you're the last one standing. It's probably not going to be there. So you've taken a subordinate position. You've undermined your position or the value of that asset by putting it in a subordinate position. So everybody else gets paid except you because it performs like equity. Number 7, the inability to leverage an asset undermines its market value. Leverage is borrowing against an asset, right? And so you can, through an investment strategy, you can use leverage to increase the market value or the performance of the asset, but no lender is going to allow you to leverage just your case expenses. There's no lender, and we know the market, there's not a lender you can say, here are my case expenses, that's the only asset I'm going to pledge to you, will you loan me against that? There's nobody in the marketplace who's going to do that. It's just too risky. And I can show you how the inability to leverage an asset can really undermine its value further. So here we have another example. House A is worth $500,000, and you can use it for anything, and you can borrow against it, right? House B, same value, but you can't borrow against it. So which house would you rather have? Well, you want house A because you could leverage it, right? Maybe you're going to take a loan against house A. maybe for 80% of value, say $400,000. You still own house A, you can take the $400,000 and invest that, or buy another house and rent that out. So the ability to leverage an asset gives you more flexibility. The inability to leverage it makes it much less in value. All right, number 8, the effect of inflation. So we're going to talk about inflation's effect on purchasing power, and we're going to do that by another poll. So here we go. This next poll is going to ask you a question about what was the price of, oh, I got to get it out here, hang on a second. Bear with me. So the question is, how much did a loaf of bread cost in 1970? Was it 25 cents, 50 cents, 75 cents, or 99 cents? For those of you who are alive then, probably a lot of you weren't, but what did a loaf of bread cost in 1970? What do you think it cost? All right, the votes are starting to come in. A few more votes coming in. You're doing pretty good in this one. Again, this is anonymous, but I'm going to close it out. About 80% of you got it right. It's 25 cents. So inflation has a very undermining effect on purchasing power, right? So in 1970, a dollar could buy 4 loaves of bread, right? We said that it costs 25 cents per loaf. In 2017, you can't even buy a whole loaf of bread. So think now about the money that you have tied up in your case expenses, if it's $500,000. Well, if you tie that up for the next 20 or 30 years, the effect of inflation is going to further erode the purchasing power of those dollars. Not only is the asset worth less, but let's assume you get it all back in 20 or 30 years. Well, if you could buy a house with that money today, if you try to buy a house with the same dollar amount, and 30 years from now, it's going to buy a lot smaller house. So the effect of inflation is eating away at the purchasing power of the money you have tied up in your case expenses. Okay, so lastly, we're going to talk about opportunity costs, and you can kind of think of this almost as a summary in a way, because it's all about opportunity costs. What's the best thing to do with your personal after-tax cash? Is it best for you to leave it in your business and let it be tied up in an illiquid asset in terms of a loan to your clients? Is that the best use for that cash? Or should you get it out and do something better with it? Maybe you could grow your practice, hire more lawyers, help more people, get better results for your clients. Or maybe you just want to get it out, get a lower risk scenario where you have your cash outside of your law firm in an investment or in some kind of a guaranteed bank account. Okay, so there are a lot of opportunities out there to do something with your cash other than put it into case expenses. This is designed to get you thinking a little bit differently about case expenses. I would like to open up now, see if there are any questions. You can use the questions dialog box to ask them if you have any right now. And if you do have questions about Advocate Capital or the AdvoTrack Case Expense Funding Service, just message me. We can follow up with you independent of that. Any questions about what you saw today? No, it doesn't look like any questions. Okay. Great, well that's all for today. If you have questions or comments, you can contact me at mswanson@advocatecapital.com. You can see our phone number on the screen. More information about Advocate at advocatecapital.com. Also, we have a YouTube channel that has the 9 hidden costs playlist on that. You can follow up on that later, and you'll be receiving an email with a link to a recording of today's webinar within just a few days. So thanks so much for joining us today, and we'll be signing off. Thank you.